Welcome to the Pearl Planning Investment and Economic Update. This is the first session that we have done for an update on what's going on in the world in 2025. And gosh, we sure do have a lot to cover. Today, I want to have a conversation first, kind of going through the headlines because there's been a lot in the first 6 weeks of the year. We're recording this mid-February. I want to talk about some history lessons, and whenever I remind people of what they should be doing when it comes to investing, I rely less on the headlines and more on practical next steps. I rely more on process and focusing on what you can control than listening to the noise. So I'm going to have some actionable items when it comes to your investments, as well as for your financial planning considerations and decisions in 2025 as we round out this presentation. But first, in 2025, there is so much that's in the news. When you read the headlines, and if you think back just over the very first few weeks of the year, we've had a lot to consider. I would start with the California wildfires. California represents one of the largest economies in the world, just on its own. And we saw very real losses in a metropolitan area that we all know well. I have a friend who's a financial advisor whose office burned down in the fires. And so that was kind of the part of what kicked the year off. But then at the same time, we have the introduction of the President Trump's administration, and they have been fast and furious as well in terms of changing the landscape and also considerations for investors and Americans. So at the same time, we've been expecting perhaps a change when it comes to taxes, but also Social Security has been in the news both in a positive manner and perhaps with concerns about cuts. Also, for those with Medicare and Medicaid, those things have been in the news. Of course, we also have a will they or won't they when it comes to tariffs. And in the late January, early February, there were announcements about tariffs coming for Canada, Mexico, as well as China. Those were on and then off, and perhaps there's a reprieve, or perhaps they will be revisited. Many think that these tariffs are a negotiating tool and not something that will last for a long time. But I will mention just throughout this presentation that we have links to episodes from my Women's Money Wisdom podcast that's also available on our YouTube channel. So I do a full episode a couple weeks back that's all about tariffs. But just one example, hopefully these tariffs are a negotiating tool and not a fully envisioned economic policy. Because here's one example of tariffs that have been proposed for aluminum in Canada to have a 10% tariff. But actually the US economy, this information is coming from, by the way, the US Chamber of Commerce. So a source that would often agree with President Trump, but the U.S. companies put the aluminum kind of production parts of their supply chain in Canada because Canada has so much access to hydropower where their aluminum is produced. And so in this example, with figures from the U.S. Chamber of Commerce, a 10% tariff on Canadian and aluminum might help about 62,000 jobs, but be harmful to industry that includes 10 million jobs. And so, that's an example of why so many investment professionals, portfolio managers, as well as economists hope that tariffs don't come roaring back. And of course, there's complex considerations. And if you want to listen entirely to a tariff conversation, feel free to listen to the podcast that we've downloaded recently and we'll have links to in our show notes. Then we have the reshaping of the government that comes from the Department of Government Efficiency, a new group headed by Elon Musk, who seems to be going through different departments of the White House and making changes, not the White House, the executive branch and all branches of government, and making significant changes. I've heard from economists who are extremely excited because of debt considerations that have come from higher spending, which is certainly measurable. I've also heard major concerns because some of the efficiency that is being proposed. It was until now considered something that was untouchable because of the social consequences and or the consequences to the economy. And so that's something too that is elevating uncertainty. Here's another headline, and perhaps it affects me more than you. At least I hope that's the case. Charles Schwab announced that they're going to allow retail investors, those who are kind of self-directed investors, to trade 24/7, all hours of the day. This is similar to what's happening in cryptocurrencies, where they've always been allowed to trade all the time. But gosh, I can't imagine my job being a 24/7 job. I really like the idea of breaks. And when people have studied what happens when you can trade all the time, they find that the second highest time for trading is in the middle of the night. And I just wonder what other things people are doing as they're trading. All of this is to say that there's a lot going on in the news. And usually we do this video in January, but I just felt like things were changing so quickly. And I also felt a little overwhelmed by the pace of change. And so we delayed the presentation until February. I don't think I can wait for things to settle down, but I do know that uncertainty is something that doesn't feel good by human nature. You know, we're used to wanting to know how things are, and that goes back to the ways we protect our ancestors protected themselves in a much different world than kind of the digital world that we live in. And so if you're feeling uncertain, if you're feeling worn down by the pace of change, you're not alone. And that is why we pulled this together a few weeks later than we typically would. I reflect on this quote by Jerome Powell, the treasurer of the Federal Reserve, who said, "We don't know what will happen with tariffs, immigration, with fiscal policy and regulatory policy." Now, if there's anyone that's informed about what is going on with the US economy, I would think it would be Jerome Powell. So knowing that he doesn't know and knowing that in humanity, with human minds, certainty feels good, even if it's bad news, I would recognize that you may be thinking, what the heck do I need to do when it comes to my investments, my portfolio, etc. And so that's what we're really going to be focusing on in the rest of the presentation. But I'll start with an assessment of the economy that isn't headlines and is more reporting information that we are able to collect over time. So let's talk about what is really going on in the economy and markets. Well, first of all, inflation was big news when it comes to the economy. It's what Americans have on their minds. I keep hearing about the price of eggs, and certainly bird flu is impacting that. These inflation numbers that I have in the presentation go through the end of last year, and inflation, in fact, ticked up with its numbers in January. So that number would be a little bit higher than the purple 2.89%. But inflation is certainly on everyone's mind because this impacts, obviously, your wallet when you're at the store. Certainly, this is more harmful and difficult to kind of control for lower income families. Additionally, it impacts interest rate policy. So those of you waiting for a mortgage refinance because you purchased a house off of mortgage lows, you're likely to be waiting further because one of the ways that economists and in particular the Federal Reserve fight inflation is to keep interest rates higher. And so certainly the inflation has continued to be something that is on people's minds and does not seem to be completely going away. Perhaps it's a higher for longer situation. And that's just a reality. We lived in a very low inflation environment for a very long period of time. And that isn't always typical. In fact, we were in a lower inflationary period than most generations have lived through. Meanwhile, and this goes back to our conversation with the Department of Government Efficiency, budget deficits have continued to linger and be higher. So there was a lot of spending during COVID, both starting with the Trump administration, which had had higher and higher deficits than the Obama administration. You can see that just cratered in the charts on the left with COVID. So you know that is 2020, 2021 numbers, but then into the Biden administration, spending continued. There was a lot of stimulus. There was a lot of attempts to continue to booster the economy, as well as social policy that had price tags and costs attached to it. So on the left, you can see, if the blue line or the turquoise line is rising, that is good news when it comes to deficits being less bad. But that just hasn't been the case over much of the last 6 to 8 years. And then you look at US public debt, and that is rising, and the cost of servicing that debt is also rising because interest rates have been higher. So public debt, something that economists hate, especially when it gets to high percentages of gross domestic product, continues to be higher. And so that's why, while many people are very concerned about increase in unemployment through government efficiency programs and layoffs, as well as department eliminations, that's why I have heard from economists that think this is what we've been waiting for. Perhaps we have a Reagan-esque time period where changes that need to be made are made, and perhaps this is good news. What do I say? Well, we're not certain what's going to happen. We're not certain where things will fall out, what's planned and what's a maybe. But we'll certainly be keeping our eyes on where budget deficits are and the impact of proposed budgets, because there's a lot in budget proposals that would impact families, especially those who could be single family members. For example, the head of household ability to file under head of household for taxes is considered to be eliminated, things like that. So what I can tell you about what would come next from that is that we will keep our eyes on what will be happening, and we will be informing you as things change when it comes to tax policy, when it comes to other government programs. Meanwhile, when it came to markets last year, you had a rock star, just knockout year last year that followed up an exceptional year the year prior. And so while people may feel doom and gloom when it comes to debt and deficits, certainly consumer sentiment was lower in 2024. I think that's part of the election story. Asset owners, people who own stocks, really had a tremendous year. And bonds, while much more muted in terms of their returns, were also positive after some difficulties in 2022 as interest rates were rising. And on top of all of that, when you look at this chart, this is a breakdown of the types of investments, a little more specific than stocks and bonds. And when you look at the types of investments that have done best, and you look over the last 1 year, 3 year, 5 year, 10 year periods, growth has been the thing for the last 10 years. And certainly if you had a time machine, you might want to go back and just load up on growth. Those technology companies that are kind of to the moon right now. But when I see these kinds of trends where it's just been one thing all the time, that makes me think about wanting to talk about diversification, because things just don't always stay on trend forever, and often they revert to the mean. So we'll be talking a lot about diversification in the rest of our presentation. Meanwhile, when we look both in the US and around the world, the economic data is kind of a tale of two cities. You've got growth happening pretty much across the board, although China's kind of recovering from a recession, but in the US, it seems to be stronger than most of the rest of the world. Then you've got interest rates, which they're a bit higher than they used to be, but they're still in a manageable territory. I know if you have a mortgage that you financed recently, you may dispute this, but I love it as a person who advises people who owns bonds. But then in red, you've got inflation rates that seem to be persistent and higher, and then unemployment rates that are rising, not falling. So all of this is to say that there's mixed data around the world, and although there's not any signs of recession just yet. Now, I mentioned that we love diversification right now. This is one of the things that I think you can control and pay attention to, and we'll be telling you how in a moment. But just look at these numbers. They're stunning. If you take the top 7 parts of the S&P 500, just the top 7 companies, so a very small fraction, 2% of the overall S&P, you would find that their returns collectively were 46%. Meanwhile, the S&P just in general, had returns in the mid 20s. But if you subtracted out the biggest companies, and these are companies we all know, Apple, Microsoft, Nvidia, Amazon, Meta, Google, and Tesla, you would find the returns much more muted, just in the teens. So this is something that is important to consider, is that we've had a lot of the returns of the US stock market in a very concentrated few parts of the market. And if you picked those individual companies and have a lot of their stock, I'm speaking especially to those who are employed there, that's been phenomenal. It's been a phenomenal get rich creator, wealth creator. But I would warn you that it may not, staying concentrated in positions like this may not be a stay wealthy strategy. And we'll talk more about this as we go into kind of our investing round. So let's talk about investments. What are some practical next steps that you can do that are actionable for your portfolio? Well, the first thing I would remind you to do is to stay positive. So I know so many people, whenever they see any headline, whether it's major losses due to fires or hurricanes, whether it's headlines that they don't align with or appreciate, or just general bad geopolitical news, the instinct is kind of a flight instinct. Let me go hide, let me get away from risk and out of the market. This is one example. So Michael Burry, really made a name for himself when he made great calls when it came to the Great Recession and the challenges that um, came at that time from owning debt that was very, very risky unknowingly. And since then, he's kind of been a prognosticator of, like, the sky is falling, the sky is falling, things are horrible, you need to get out of the way. And so these are examples over the last 6 or 7 years of times when it was just like the world is ending. We're going to have another 2008. We're going to have another 2009. And gosh, that's just not been the case. And when you are overly focused on a narrative that can be quite negative and harmful when it impacts your family and your life in general, that can make you change and make adjustments to your financial portfolio. I always like to tell people that the tried and true method and process to build a successful investing strategy is to maintain a discipline with an asset allocation you can live with that fits with you and your risk. And so really deviating from that plan at any given time can be very difficult and harmful on your returns. Many people, when you see phenomenal returns in individual stocks, feel like you kind of want to go to the casino. You're missing out and you'd rather make money big over time. And it's just not the case when it comes to investing if you are disciplined and if you invest with diversified portfolios, as well as if you invest long term. So I like to remind people that investing is not gambling. It is putting money into strategies that have value, whether they be stocks or bonds. If you were to go to the casino on any given day, your odds would be against you. The very best odds are a craps game with a 50-50 shot of making it. And it goes down from there. But when you are someone who invests in the stock market, the odds that you're going to have a positive return over time based on historical data, I know that we can't predict exactly what returns will be, but they're extraordinarily strong. So looking at the top of the chart on the right, 100% of the time that you were invested in the S&P 500 for a 20-year period, returns were positive with an extraordinary highs coming off of the great bull market of the 1980s. When you come to 15-year returns, 100% of periods were positive. When you go to 10-year returns, 92% of periods were positive. The exception being the great periods in between 2000 and 2010 for the most part, as well as a portion of the 1970s, very, very briefly. In both of those cases, diversification and owning a few different things would have helped out a lot. And even in a shorter time period, like a 1 year period, positive outcomes tend to happen much more often than negative outcomes, about 80% of the time. So that's what you get just when you start and launch into a diversified portfolio. Now, if you deviate from the strategy and you just start to miss one market day each year, the first day of the year in this example, that can have a huge impact over a longer period of time. This is kind of intended to illustrate times when you decide to kind of hop in or out of the market. Whether you're right or wrong, if you do it repeatedly, you're not likely to be right. In fact, I'd say the odds are much more similar to that, the odds when it comes to gambling. And so you can have material differences in your overall returns just by missing one trading day per year. And in this case, looking at investments in the S&P 500 over a long 25-year period of time, the difference is, significant. It's more than 40,000 just missing one day a year. The other thing I would say is do keep investing. So one of the things I hear when people feel concerned is, oh, I pulled back. I just quit putting money in my 401k, or I'm moving to cash. I'm not going to invest anymore. Just a simple investment of $50 a month can really be phenomenal when it comes to returns. And that's what the example is on the right. In orange, you see the returns of the S&P 500, $50 a month going back to the same period to 2000. And the diversified portfolio of the 60/40 portfolio in purple, same deal. Now you compare that if you just bought $50 a month in cash, you'd have $15,000. So you're tripling, if not quadrupling your money, or a five bagger by being disciplined in investing. I love to use that example to remind you of the power of your retirement plan contributions, which for many of you are being put in with every single paycheck. Now, I mentioned so much of the stock market is concentrated, and the returns of the stock market has been concentrated in a small number of companies. But the profits of the stock market do not reflect nearly as high of a percentage within those companies. And so I also know that many of you are receiving more and more compensation as stock through restricted stock units and similar programs. And I just want to remind you with some history lessons why it doesn't make sense to have too much of your net worth tied up in any single individual company. So during the time frame I'm showing you, going back to 2000, the S&P 500 grew to 700,000. But you look at these four examples, which were really darlings of the late 90s. You have Boeing, which did phenomenal into 2018, but then has had a lot of trouble since then. They rose as high as 1.7 million, but certainly you wouldn't feel like as much of a winner if you saw your 1.7 million turn into 700,000. Meanwhile, Intel started in this time period with around 110,000, and over a 25-year period, you've only got 188,000 to show for it, much less than the 700,000 approximately that you would have had in an S&P 500 investment. Look at Intel. They started with 110,000 in this example. 25 years later, or no, Intel. The orange example, excuse me, is GE. And that's a company that everybody wanted to own, similar to perhaps Nvidia today. In the late 90s, Jack Welch could do no wrong, and they've really gone almost nowhere since then. And then Citigroup or Intel is an example which has actually lost money over that long time period. Even as I showed you the example, the diversified diversified indexes like the S&P 500 just don't have that batting average of losses in any similar manner. And then finally, we have Citigroup, which is, just flatlined over time. So you don't want to be subject to the whims of an individual company, because the odds are much more like that casino than they are like the predictable long-term returns of they are variable but tend to be positive of diversified markets. So my theme for you as well is diversify, diversify, diversify. And it's easy to forget this when you have a US stock market, especially in the very largest companies, that has just been amazing and tremendous in terms of its ability to create wealth for people. But fortunately or unfortunately, my career is approaching almost 3 decades, and this isn't always the case. It's not a sure shot to just put all of your money into US large company stocks. I'd like to remind you of a couple of the time periods where this hasn't tended to work. The first on the left is looking at small companies versus big companies in the US. And when you look at small and big companies, oftentimes the big guys are the winners when you're in a period of excessive innovation. Think of the things that kind of change our society and concepts that really have stuck with us. So you have the space age of the 50s and 60s. You have Internet 1.0 in the 90s, and then you have the age of AI today. And so the pace of change is getting quicker and quicker. And the ability to kind of capitalize on that for the companies that have the most money and can really pounce on or purchase the technology that's going to work for the best tends to lead to outperformance by the very biggest companies that have pricing power, they have dominance, they have wide moats, they are strong. But there are lengthy periods of time in economic history for observances of stock markets where smaller companies can take advantage of some of this evolution. They too can start to use AI processors and have better efficiency in their workplaces. We've been in a time period where small companies were out of favor, but for considerable periods of time over history, the pendulum swings back to smaller companies. So I would remind you that you shouldn't have every piece of stock investments in your portfolios only in the biggest companies, and certainly not in single company stocks. The same goes for international. In this example, I really want you to focus on the left side. This chart is really for going from 2000 to pre-2008. It's difficult to remember because it's so long ago, but this was a really difficult time to be an investor because there was a prolonged period of time where US large company investments just were not working. And in fact, this coincides with kind of the unwinding of Internet 1.0, where there were a lot of businesses that didn't really know how to make money, that had extraordinary valuations on the promise of what the internet could bring. And so during the time period after that, as the stock market worsened, international stocks really took off and led the way. And so again, this is a reminder when US stock markets don't work, which we can't predict. I'm not saying that that's going to happen right now, but what I would remind you is that there is value to have international investments in portfolios today, especially as we've lengthened the time that US large companies, as well as growth especially, has dominated. Interestingly, when you look at the beginning of this year, um, international companies and value companies have been leading the way. So they have, it's a very short period of time. It's just an anecdote. It's not necessarily a full-on trend. But I thought that was interesting that right now international and value are leading the way ahead of, for example, the S&P 500. Now, people have gotten really excited and really comfortable in owning cash and CDs. And I get it. You used to not be paid anything on your cash, and now yields went from nothing to, in some cases, 5% a year ago, and still in the mid fours today. Um, Now, when interest rates changed, that was the function to fight inflation that gave us this yield that was real. What a gift if you're a saver instead of a borrower, and what a punishment if you're someone who needs to be lent money. But I want to remind people, because when they have that cash in hand, the surety of 4% or 5%, it really feels stressful to put money in the market. And in some cases, also, we're seeing people that are replacing their bond investments with CDs or cash. And the CDs typically are very short term. So on the left is a chart that talks about inflation versus money markets. And this looks over time when you have feisty inflation that continues to be higher and you compare it to the returns you get from money markets, cash doesn't tend to keep up. And of course, if you have cash that isn't getting a yield at all, that's even worse. So the purchasing power on money markets, in this example, we're using a money market mutual fund that has a track record that goes back to the 1990s, really tends to decline in relation to inflation. And so remember that your purchasing power isn't always, isn't typically being preserved when you keep everything in cash. Cash certainly has a place, don't get me wrong, because we want you to have money funded for emergency reserves as well as what you may need over a 1 to 2 year period, or, very short term. But do remember that there are other places you can put money that is intended to be longer term that can have a better chance of fighting inflation. Now, the chart on the right is important too, because I feel like when people are looking to buy either CDs or bonds, they, bought the CDs as they ran up when you got 5% and bonds were still priced at 2. But when there's inflection point, at some point, interest rates will, instead of stabilizing, perhaps go lower, like they had a little bit last year. When you have that peak in terms of interest rates for CDs, and then you compare the returns to short-term bonds, municipal bonds, to core bonds, as well as additional diversified bonds, you find that in many, if not most cases, the CD rates tend to trail. The only exception being when you had kind of the Great Recession, or things were starting to kind of become unwound before the Great Recession. But you may be materially harming your return perspectives when you just own CDs and cash. And the other really critical function that I've been reminding clients again and again is that if you own cash, for example, and we go into a negative market, let's say that you're more concerned about what's going on in the economy, or in Washington, you think things won't be great, then your cash and your CDs are like an elevator. They give you a yield that's higher, and then if there's a recession, if there's a really bad market, the Federal Reserve aggressively lowers interest rates and you go down the elevator, you don't have a way to get back up. So you've just kind of locked in lower rates. Meanwhile, for bonds, they're more like a seesaw. So bond rates, when yields go up, bond prices go down because those bonds are not as attractive as newly issued bonds with the new yields. But it works in reverse too. So if you're really concerned, what if there's a disruption in the economy? What if something unexpected happens with new presidential executive branch policy? This might not be good for the stock market. I'd much rather own bonds in many, if not most cases, rather than cash. And this is a little bit of a busy chart, but first of all, on the left, the table part shows you that we have real yields when it comes to different types of bonds, anywhere from the 4 to 8% for more levered loans, which are loans for companies that don't have as good of traditional lending options. Meanwhile, this is a prediction, not 100% forecast, but probably about as good as a snow forecast as to what would happen if interest rates went up by 1% and if they went down by 1%. Now, if any of you are students of markets, you'll know that in 2022, we had interest rates about 0, maybe 1, and they went up to 3, 4, 5. And what happened was there were very bad returns in bonds. But when you start with interest rates that are 4 or 5, when interest rates go up by 1%, you still get paid your 4 or 5%, as well as the price adjusting. So you can see on the left, the bars to the left, which is if interest rates go up by 1%, those aren't nearly as bad as what we saw in 2022. But then focus on the bars on the right that are navy, the darkest bars, because that's the prediction of what might happen if interest rates went down by 1%. So if you use a 10-year treasury, which is a common standard of like kind of government bonds to be owned, you get 4.5% today if interest rates stay the same over a year. But if interest rates go down because there's a bad economy, because there's a bear market, because there's a new unexpected disruption in the world that we live in, then you get positive returns in bonds. And this is indeed what happened in the worst, like most prolonged recession and stock bear market of recent memory, which was 2008 and 2009. So the blue line is your cash, as the purple line, your stocks are cratering going into 2008 and then bottoming out in March of 2009. I remember these months well because I lived through them, and they were a very difficult time to be a financial professional. And yet that's when your financial professional really earns their money, because they're talking you through the moves you should make in a very difficult and downbeat time. But meanwhile, the orange line is the return of bonds. And you can see that bonds were, for the most part, beating cash during the downturn. And then even as the stock market started to recover, they stayed ahead of the stock market for a considerable period of time. And so I feel like we need those reminders of these lessons from the past, because it's been easy to forget them when you had a zero interest rate environment. But it could be relevant, and no predictions of when. I'm not saying that this is not a doomsday forecast, but if you are concerned, one of the best ways in a very low cost manner to buy more exposure to something that could protect you would be to own bonds, perhaps instead of cash, after you got through the emergency reserve that you should have. If I were to be getting down to brass tacks of things that I want you to remember, I want you to have cash on hand and set your cash targets based on the life that you lead and what you might need. I want you to rebalance. So if you haven't been paying attention to your portfolio for the last 4 or 5 years, really had it be a fix it and forget it, and took advantage of the great returns of the stock market, I want you to look back and decide what the right mix of stocks and bonds is, or revert back to your original allocation and make some trades to make adjustments. I want you to rethink your bond allocation and remember why you own bonds and don't just own cash. I also want you to make sure that you own mid and small cap companies. It doesn't need to be your entire portfolio. When we invest for people, large companies are still the biggest portion of our overall equity portfolio, and yet we always intentionally own some mid and small cap companies. The same goes for international. You should own international and have that be a part of your portfolio. And then we didn't go into many specifics, but alternative investments can sometimes not depend on the returns of stocks and bonds. They behave differently, and that also can help to either mitigate risk or build resilience for portfolio returns. And most of all, even though this isn't the main focus of our presentation today, I would say don't give away your returns in terms of tax bills. I really think that many parts of investing, while not always effectively executed, are easily accessible in a way at a very low cost. But I see so many dollars being given away by tax strategy that is not informed, by advisors that don't incorporate tax considerations into their decisions on behalf of their clients, and by people that are just unaware that there are strategies for you to help be under control when it comes to your taxes, if you're someone who receives equity compensation, in order to strategize there. And so I just want to remind you to keep an eye out for tax costs. It's a perfect reminder, perfect time, because you're getting your 1099s from your tax returns last year to see if you have a tax-aware portfolio. And of course, there will be times when you pay taxes, but you should be able to talk to your tax professional or your financial advisor and understand why there are tax costs, and also just have a discussion to see if there are opportunities to mitigate the taxes, as we often discuss with our clients. Now, we're financial planners, and investments are only part of what I do with clients. So I want to remind you quickly of some practical next steps when it comes to everything else that involves financial planning. So here are some financial planning reminders. First of all, so much about what I'm talking to people about today is a reminder to focus on what you can control. Money is inherently emotional. It is not, none of us are rational investors. And so remember to focus on your well-being, focus on the things you can control, and focus on the other areas of financial planning, because they can make you more prepared for anything that comes around the corner. And I have our little symbol for the Women's Money Wisdom podcast because we had a great episode recently with Dr. Daniel Crosby, the author of Soul of Wealth, talking about the psychology of money. So I would definitely send you to listen to that episode, which is a great one, and read his book. When it comes to tax planning, which I just got up on, did my tax TED talk, as I love to do. I would say watch for a shifting landscape. There's so many proposals coming between the Senate, the House, and things that President Trump campaigned on and or has proposed recently. I have no idea what the tax landscape will look like going forward. I know it's not likely to revert to what was in existence before the Tax Cuts and Jobs Act, which is set to sunset later this year. So watch for the shifting landscape and listen to informed financial planners and tax professionals when we know what is happening. We will be communicating frequently as things change, and so keep an eye out for that. Do get your taxes done now. We're recording this in early tax season. There are fewer and fewer professionals. There's higher risk of fraud if you delay your tax returns. And frankly, there's just fewer people working at the IRS that can answer a phone if you have a problem. So get it started now. And if you need a new tax professional, find them now. Do be careful about tax conscious financial decisions. And when you need help, ask a professional. And pay attention because if you inherited an IRA or a retirement plan in the last few years, there's been a change to the rules, and you will need to do, in many cases, not all, a required distribution this year, whereas interpretation of the law in previous years was that you had 10 years but didn't have to do a distribution every year. We have more information elsewhere on this, but feel free to ask us or a financial professional if you think you may be impacted. When it comes to retirement planning, with all this uncertainty, sometimes I feel like people are more focused on changing their investments when they should be looking at how they're preparing for retirement. So update your retirement plan if it's been a while, if you're feeling insecure when it comes to your career, or if you're approaching retirement. Also, make sure you're incorporating a plan that addresses the complexity of retirement. Retirement isn't just dollars and cents. It's not just a check that goes into your portfolio or your bank account each month. It's also a sense of purpose. It's how you're going to spend your time. There's a lot of complexity when it comes to tax decisions, which we often help people with. So do be planning for the multidisciplinary aspects of retirement if you're someone who's starting to think about it more and more. And to this end, here's another podcast episode we did recently in December with Christine Benz, who's Morningstar's Director of Personal Finance. She wrote a tremendous book called How to Retire, which was published last year. And I got a chance to sit down with Christine and talk about her experiences in researching retirement and talking with some of the most prestigious experts in retirement in the personal finance community. So I would listen in on that podcast. When it comes to insurance planning, I started with the fires in California, and we had a catastrophic and devastating hurricanes in the southeast through North Carolina last year. Do make sure that your property insurance is adequately covered. And if you're moving around the country, do inquire about the availability of homeowners insurance in the places you're moving, because there are certain parts of the country where it is extremely difficult to become insured, or you may have to be underinsured or at risk. We also are talking to people who are concerned about the needs of an elder or aging population and want to talk about long-term care. We don't like to sell based on fear, but this is also something that you may want to consider talking about if you're middle age. People become much more interested in long-term care as they approach retirement in their 60s or early 70s. But the best time to consider whether you might want to insure yourself is actually younger, in your 40s and 50s. And then for life insurance, we see some people that are overpaying for permanent policies that really had been sold as a retirement plan, but aren't going to turn out to be the best way to plan for retirement. So either you may be overpaying, or if you're underinsured, then looking at low cost, long term life insurance may be the way to go. When it comes to estate planning, let me just reflect for those of you that are more technical financial planning watchers. We spent a lot of time over the last 3 or 4 years, and I say by we, I mean the financial and tax and estate planner profession, anticipating some changes that are no longer likely, where the estate tax kind of hits for people that have well over $10 million, and we thought those things would revert. But now with the new Trump administration, that is not likely at all for the next 4 years. But I get back to basics when it comes to estate planning. There are so many people I know that intend to have an estate plan but haven't gotten around to it. So if you haven't created your estate plan, or if you really need to update it, now is the time. I can't emphasize enough that when you're in a circumstance where you need the help of a well-planned estate plan and it's too late to do it now because someone's infirmed or has passed away, that you will really regret not taking action now. Also, do review your beneficiary designations, because often they can be a critical part of your estate plan. And if you don't review them, you may have people listed who are no longer in your life, and other people that are left out. I had 2 great episodes with terrific estate planners, Ashley Waddell Teamstad talking about who needs a trust, and Jenny Roselli talking about estate planning lessons from celebrities, from celebrity estates. And so do check out those episodes and consider making now the time to make some changes. When it comes to college savings, there is potential in some proposals for a much harsher consideration for student loan forgiveness, also potentially scholarships being taxed, and just changes all around. So now more than ever, I would say remember to not put off college savings. Have conversations, open that 529 plan if you think that's right for you, and review your game plan. We also have some great podcast episodes on college savings. In particular, I would look for the episodes we have with Ann Garcia, who is a rock star financial planner expert when it comes to estate planning. Charitable giving is something that many people, especially as they age, consider to be more and more important. It's something that's near and dear to my heart. Do pay attention to tax changes and whether with new taxes you will be more benefited from charitable giving. I can't predict what those changes will be yet, but we will certainly be listening and communicating when they are. If you have that concentrated stock and are looking to lower your taxes, gifting appreciated stock and getting a charitable deduction can always be beneficial. And if you are RMD age, not from an account you inherited, but from an account that you saved yourself, then do consider a qualified charitable distribution for a better tax advantage if you are typically writing checks to a charity or church of your choice. When it comes to getting things done, we always love an incremental approach. And I just saw this late breaking data about Americans who work with certified financial planners. Now, I'm biased, but when you compare them, because I am a CFP, but when you compare the results in terms of how people feel when they work with a CFP to when they don't have an advisor or work with a financial advisor who's not a CFP, they're more likely to have a detailed financial plan. They are more likely to feel like they are living comfortably, more likely to have an emergency reserve and a will or trust. They have higher trust in their advisors. They're more likely to say they're planners, understand their family and their values, and takes the time to learn about their whole family and their relationship with money. And they're less likely to have interpersonal conflicts when it comes to money. And I just love this research. And of course, I'm biased, but I love the work that many CFPs do. And that said, if you have follow-up questions, we hope so many of you listening are friends and clients of Pearl Planning. But if you don't know us already and would like to reach out, feel free to contact me, Alexa Kane, or Tony Wander. All of us are certified financial planners, and you can find our contact information and or schedule a visit by going to pearlplan.com/contact and or visiting, making a phone call. I always have to make sure to include our disclosures as we continue to communicate, but do consider subscribing to our YouTube channel, because you will be able to get updates as we update you on the things that are changing in these uncertain times. Thank you so much for listening, and we appreciate you.